We're 90 minutes into trading. It is Monday, September 20th. We've got a big market sell-off, folks. Let's take a look at what the market's doing. Let's take a look at how the table has been set for us for a number of days. You know that I always want to prove that I've been telling you what the heck the market is showing us days in advance. I'm going to go into my chat room right now and I'm going to show you comments from last Thursday. This was an excerpt that I posted this morning about a half an hour before the open. These comments were posted last Thursday. Then we'll take a look at the market chart and I'll show you exactly what I was looking at. Pre-open comments for Thursday. Day traders, watch carefully. This is where the rubber meets the road. The market would have normally run hard after we tested the 50-day moving average, and it would have shot higher to the previous all-time high. That's the pattern that we've seen for the last year. Month in and month out, that 50-day moving average has held. But what we saw last week on Wednesday was that the following Thursday morning, we are not seeing that type of price action, and this is a warning sign. If the market reverses the gains from Wednesday with ease, it'll be a sign that sellers are still in control, and at very least will test the 50-day moving average. I'm leaning in the bearish camp, and my opinion is that the dark clouds fundamentally are mounting. And I explained that in my pre-open market comments, which incidentally, in this YouTube video, when you go into the comments section, I have a link to my Twitter feed, which you'll be able to read my pre-open market comments for free each day. Please, don't take my word for this. Go back, read my comments from last Thursday, and then you'll be able to see that this analysis has been very, very accurate, and you'll be able to catch up on the fundamental news that I think is going to be problematic for us. So I'm going to continue to scroll down in the chat because I want to show you my pre-open market comments this morning. This is where I tell everyone what the heck is going on and how they should position themselves. I'm going to go down. You can see the Evergrande interest payment that's due this week is a problem. They are likely to default. This is a problem because credit is the one thing that can produce a sustained market decline. We don't know how broad-based this problem is. We don't know if China is going to come in and bail out. We don't know if there are other problems in China. But as I've been saying for the last couple of months, we're into this recovery from COVID. China has a 10-month head start. China is the global growth engine for the world. Why is their market in bear market territory? Doesn't make sense. Why is their economy struggling? Doesn't make sense. When you get a disconnect like that, especially when the S&P 500 valuations haven't been this high since the tech bubble of 2000, that is a red flag. We're also in September. So the sell-off that we're seeing today is no surprise. So we get the sell-off, we come in this morning. What should we do? Here's what day traders should do. They should wait for the dust to settle this morning because on the open, you're going to see jacked up option implied volatilities, mile wide bid ask spreads because the market makers are backing off of everything. So do not trade the open. The only way that I would trade is if I had 4 consecutive long green candles stacked one on top of the other without any overlap. That is very unlikely to happen. The worst day trading scenario for us today would be a drop and then a steady continuation. And that's because that would be a gap and go formation to the downside. And I would not want to be joining that because there is a chance for a violent snapback rally after a 14, 15-month bull market rally like we've seen. Not a good trading setup for us. However, the best day trading scenario is an early bounce that fills in some of the gap and hits resistance after 30 to 45 minutes of trading. That move will help me identify a relative weakness and it'll give me time to evaluate stocks and the market. Jacked option IVs will drop, the bid-ask spreads will start to tighten. I will be looking for opportunities to short. Be looking for tiny candles on that bounce and a bearish 1OP cross. That is the table that I set for my members each day. So, got this little bounce in here. tiny, got overlap in the candles. There's your open, your close. So we're getting some overlap and we're starting to roll over and we get this bearish 1OP cross. Right now, we have not been able to take out the low of the day, which on this 1OP bearish cross, I want to see. Before we go into deep, deep negative territory, I want to see us crack that low of the day. I am short currently. If I don't see that, I am going to take that as a bullish sign, a sign that we're at very least going to bounce a bit, and then I'll look for opportunities to reshort. If during this bearish 1OP cross, the bottom falls out and we make a new low of the day, that will tell me I'm on the right side and that the selling momentum is likely to pick up. On a big drop like this, I would be looking for that momentum to start picking up. Let's go into the daily chart and see what the S&P 500 has been doing. Now you can see on this decline, I had mentioned to you last week that we were seeing red candles. What exactly does that candle tell us? It tells us that the opening for the day has been close to the high of the day and that the close is lower than the open. That's why we get a red candle. So we can see here on this chart, long red candle in there, open on the high, close on the low, open on the high, close on the low, or close to it. This is a sign of weakness. We also have a downward sloping trend line. Let's put up those major moving averages so we know where they come into play. The 50-day has been what everyone has leaned on for a very long time. And we can see every single time we touch the 50-day, zoom, we're gone. Well, we had just barely touched that 50-day moving average last week. We're right above it, and that was the price action on Wednesday. See that long green candle, that big bounce? Well, that's what we've been seeing all along in here, and this was the tell. As I'd said Thursday morning, normally what we would see after coming close to the 50-day moving average, after the market filling in all that candle, that red candle, almost reversed. What we would normally be seeing is a long green candle, challenge the all-time high. That's why Thursday was a pivotal day for us. But you can see how the market actually sold off Friday and it closed below the 50-day moving average. This was the tell. This time is different. And I had also mentioned that this is the heaviest selling pressure that we've seen in many, many months. All of these are 1, 2, 3, go. 1, 2, 3, go. 1, 2, 3, go. This has been persistent selling, selling, selling for almost 2 weeks. So this time is different. You can see this is the market right now. We're very close to the 100-day moving average. I think that this week we're going to be testing it. That's a logical level for the market to get down to. I believe that that interest payment by Evergrande is due on Wednesday. So that would mean Thursday morning we'll know what's happening there. And we also have a FOMC meeting taking place Tuesday and Wednesday. We already know the Fed is going to be as dovish as possible. They have been all the way to this point. So, in light of the market selling off, in light of potential credit concerns in China, they are going to have their foot on the accelerator, not on the brake. So, look for bullish statement Wednesday, maybe even a little bit of a market bounce. Depending on how heavy the selling is these 2 days, that could be an opportunity to reshort. I would probably be buying back any short positions ahead of the Fed for very short-term traders. Let that news settle, see what they have to say, look to reshort on any kind of bounce in here. So the market is breaking a major upward sloping trend line as well. We can zoom out and take a look at that longer term picture. You can draw all sorts of trend lines up in here that have been breached. I tend to prefer shallower trend lines that touch as many points as possible. That trend line has also been breached. So we're resting right at that 50-day moving average. What should you do now? Pete, should I go out there and load up on puts? Should I be buying puts like crazy? Well, you've kind of missed the gun a little bit because we've got this big gap down. So you're going to see very expensive options. Option implied volatilities are starting to get very, very pricey. I'm preferring to trade the futures from the short side. When you have moves like this, it's important to use wider stops and to trade smaller size. Why? Because these moves are going to be violent, especially when you've had a bull market rally that's lasted almost 12 years, especially when you've had a gangbuster bull market rally that's lasted 14 months. You're going to have buyers come in and they are going to put the hurt on short sellers. So you'll get these violent big green bars upward, and you need to be able to weather some of those with your shorts. If you're trading big size, you're going to get shaken out of your position and you're going to have to weather some of those big moves. And then gradually the market will start to come back in and the next leg lower will happen. Well, if you're trading big size, these moves are going to shake you out and you're going to be nerve-wracked. And it's very likely that we're going to see some S&P moves where a 5-minute bar could be 10 S&P points. So trade smaller size, keep your stops wide, try to be short as long as you can on the market. Now, I don't know how this bearish 10P cross is going to play out, but I do want to see us take out the low here. You can see buyers have been very stubborn. They're kind of making a stand right here, but I want to see that cave in. And once that caves in, then buyers will be more and more passive. They'll start pulling their bids and we'll get that drift lower. That's what I would be looking for. Now, oftentimes, and I've done this for probably most of my trading career, is when I get these big moves and I'm short, I take profits. And I look for the next entry point and then I take profits. But what I've realized is that if you do have a trend day, and we won't know that for about another half an hour or so, we need that new low and we need it very soon. If we do get that new low of the day, this is likely to be a bearish trend day. And on those bearish trend days, once you establish your short position, you're almost better off just turning your computer screen off until the last hour of trading, because all of this in and out, what happens is that you ultimately miss those big long red candles down and you're in on them too late. And so just leave well enough alone, stay short, know that you want to be short, know that this is a major market breakdown. You can already tell that if you are a large asset manager and you are looking at this price action right now, is this when you need to be out there gangbuster buying? Probably not, because this is different than this, this, or this. This looks like there's something serious mounting here. This is a risk off mode. And if you're looking to get long and buy stocks with this type of selling pressure, you're going to be pretty passive, because now what you want to see is you want to see a big drop. You want to get those bargains. You want to buy those stocks as cheaply as you can. And you'll be looking for something that's more like this. Now, this would need to unfold over a period of maybe 2 weeks or so, but it would be a hard bottom, a nice little bounce, and a retest with a higher low double bottom. This is what asset managers are going to be looking for, more of a pattern like this. But again, this unfolded in the course of a week. After a drop like this, you're probably going to be looking at maybe 2 weeks or something like this to unfold. Then they will be more aggressive and they will be buying. They'll also be through the Evergrande news. We also have the debt ceiling that we're approaching right now. So are politicians going to drag their heels till the last minute before they sign a deal? Yeah, probably. Market probably not going to like it. So there is some bearish news pending. I think the market's going to continue to go down. So I'm going to go into one of my favorite searches. I don't know what I had put on my Friday or Thursday video. Quite honestly, it doesn't matter. Whatever it was, if it was bearish, is probably working out fantastically. If it's bullish, probably not working out, because we have market conditions that are changing now. And you know, in my videos, I've been telling you, keep your trades very short term in duration. Why? because I felt that the rug was going to get pulled out from under us. And that's why I wanted to be in trades, mainly for day trades, on occasion, an overnight swing trade, but very, very short term. And for you longer term swing traders who have been waiting for a market pullback, guess what? Our time is almost here, but we have to make sure that we are going to get excellent market support. We don't need to be in here catching a falling knife. We need to wait patiently for that support to be established and for that support to be confirmed. Once it's confirmed, then we can get long, perhaps even for a longer term swing trade that lasts 2 or 3 months, provided that all the credit concerns start to kind of go away. We see that China's coming in and helping to bail out. We know that there's not another financial firm and another one that's on the ropes. We'll have that information coming out over the course of the next 2 or 3 weeks, maybe the next month or so. Tread cautiously, favor the short side. So let's go in and take a look at stocks that look attractive to us. Now, MSGS is actually one that I like on the short side, and I'd mentioned this to you last week. Double top in there, nice downward sloping trend line, breached the 50-day moving average. GS is below the 100-day moving average. GS has exposure in China, so does Citigroup. In fact, as far as the U.S. banks are concerned, Citigroup has some of the largest exposure in China, breached below the 200-day moving average. If credit concerns are real, this stock is going to be hurt. And I think banks in general are very soft today. I took a look at MS and I like that chart a little bit better because you've got a longer term upward sloping trend line right here that's been challenged. Let's zoom out, take a look at that. And now you can see you've got one trend line that's coming in right like this. I'd be watching that closely. So when I see a trend line like that that's of interest to me, I'm going to click that and I'm going to click that. And that passes that line through a number of significant points right in here. So I see this as a pretty valid trend line. If it comes down to that trend line and it breaches it, it's probably going to test the 100-day and it may have a chance to fall even further. I think MS sets up well for a short. What about the tech stocks that have been flying? Let's go into a longer term, or let's go back into our normal screen view and see what we've got that might look good on the short side. Major horizontal support there being tested, major upward sloping trend line here. I'm just going through and taking a look if there's anything else that I like, but I think MS is going to be the short of the day. You've got a horizontal support level that's been breached there. The 50-day moving average has been breached. Stock is below it. I think it's got an easy path to come down to these two support levels. So MS is your short of the day. And I like Citi on the short side. Let's take a look at Apple, see what it's doing. You've got a bit of an upward sloping trend line here. 1, 2, 3, below the 50-day. Apple looks a little bit soft to me. I'm going to go with MS and I'm going to try and keep this video fairly short. We'll go back in, we'll take a look at what the market's doing right now on a 5-minute basis. So here we are 2 hours into the open. Within the next 20 minutes to 30 minutes, I want to see a new low of the day. If we get it, this is going to be a bearish trend day. If we do not get it, I would close down my short positions and I will be waiting for a market bounce that I can short. I don't think that we're going to take out the high of the day, but I am going to double click here and drop an alert line in case we do. Then we're going to go into the gap. So now sellers are being tested. Pound, 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 pound. Yes, there have been some buyers in here. Once the support level gives way, you're going to see continuation on the downside. If we get that breakdown, assume that a bearish trend day is in place and that your best way to trade this is going to be to get short and to stay short. This 1OP indicator will actually help us. What I'm looking for is I believe we're going to see a nice drop below zero and the market making a new low of the day. The next bullish cross is likely to be a bearish divergence. Means it normally would spark buying, but in this particular instance, the market is going to stay near its low of the day. Then the next bearish cross will be a good one, and the market will take another leg down, probably down to that 100-day moving average. That's where the market wants to go. It wants to see if there are buyers down there. I expect us to get there, if not today, sometime in the next couple of days ahead of that FOMC meeting. You get a massive market drop. Going into that FOMC statement, I would say you probably want to cover your shorts because they're going to be extremely dovish. You get that market bounce and that violent release. Then I would wait for the next shoe to drop and wait for another shorting opportunity to surface, provided that things in China are still ugly. So make sure that you're watching those headlines. Good luck with your trading. We'll see you tomorrow. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.